Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, contribution cap increases from 1st July.
Dallas, it's the 1st of March 2021 today, and just last week we got notification through that the government is actually indexing up the contribution caps from 1st of July 2021. So the $25,000 that you're able to contribute and claim as a tax deduction is called the concessional contributions cap.
Yep.
We talk about that a lot, of course, because we target that for every single one of our clients almost that is approaching retirement. We're targeting getting in $25,000 each year for them. And so that's just gone up to, that is going up to $27,500.
I feel like before we get started on this podcast, we should really dial it down a bit with our excitement. I feel like we're way too excited about this.
I am excited about this.
It's the average, the person who's listening to this is probably thinking, you guys need to get a life. Like, this is not that exciting, but for us and for our clients who are trying to build up their retirement savings, it is. Like, this is what we get excited about is to come to work and these are the changes that we talk about that, righto, this is what the government has put in place. What do we do based on this?
Well, what I get excited about on this one, the $25,000 limit is going up to $27,500. That means every single person can put in an extra $2,500 and claim that as a tax deduction.
Yep.
Now, for most people, that's going to pan out to be about $1,000 extra free money in terms of tax return that they'll be able to pick up.
Yep. Yeah, that's right.
That sum of money, and somewhere in that vicinity.
Yeah, and that's exactly right. It's that, we've talked at great length before. Like you said, you've probably heard us talk about 25,000, that contribution, concessional contribution cap, 100 times if you listen to this podcast on a regular basis. So we're not going to go back and change all of the podcasts we've already recorded, but just know that from 1st July, that figure is changing. So every time, if you're going back through our backlog and listening to the 25,000, there's actually even more of a bonus that you can take advantage of, more tax savings you can pick up, all of that kind of thing. So that's the concessional contributions cap. Now, just to clarify again, Michael, that's the total amount each year that can go in as before tax contributions. Now, that includes any employer contributions that are made. So if you're earning $100,000 a year and your employer pays 9.5% contributions, that's $9,500 going in. So the $27,500 cap includes, that $9,500 comes under that. So
you can put in $18,000 and claim that as a tax deduction.
Yep.
A maximum of $18,000. That'll take you up to $27,500. Combined
of concessional contributions. Yep. So that's the one of the things, and you touched on this, but just to explain why that happens, this is all a calculation. That this isn't a new thing. It's basically just a reworking of a calculation where these limits are all based on what they call is it a WOTI? Is it that's the figure they use, the average figure. Weekly ordinary times earned.
They've been indexing it based on a WOTI figures, I think. Yeah.
So the government basically just looks at what the average wage over time. These limits are just indexed up by the increase to people's wages to reflect the fact that obviously getting 25,000, getting a contribution cap of 25,000, that's, it's got to go up because everyone's wages is going up, so this isn't some new rule. It's not as though anything structurally changes. It's just a new limit based on wages going up. So that's the 27,500 is the concessional contributions cap. What else is going up?
The non-concessional contributions cap is going up from $100,000 to $110,000. Now, basically, that's always pegged at 4 times the concessional contributions cap.
Yep.
And that non-concessional contributions cap, look, in layman's terms, it's just money that you're putting in tax-free, and you're putting money into superannuation. You're not claiming a personal tax deduction for it.
Yep.
and there is no tax levied on that money as it goes into superannuation.
Yep.
Compare that, of course, to the concessional contributions cap.
Yep.
I put in $10,000. My personal tax return is my personal marginal rate of tax is 39% in this example.
Yep.
I claim that $10,000 contribution as a 39% tax deduction. 15% tax is then levied on that $10,000 in that example going in under the concessional contributions cap.
Yep.
Non-concessional contributions, money goes in not being claimed as a tax deduction, although you'd like to in some in some circumstances. Money goes in because you're not claiming it as a deduction. Then there's no 15% tax levied on 0% tax levied on that money going in. Now that's a big one in terms of people selling properties or selling a business. So I spoke to some clients the other day selling a business. There's some money that can go in under the small business capital gains tax exemption, but then they've got a whole big whack of money outside of that that they're looking to get in as well. So this is what we use the non-concessional contributions cap to get more money in to super prior to them retiring. So,
and I guess further to that as well. So the non-concessional cap is going from 100 to 110. What that also means is the bring forward contributions that you can make, where you can actually bring forward 3 years of those non-concessional contributions. That you can put $330,000 in as a one-off lump
that's
sum.
a good point.
To use up your 3 years worth of contributions.
Yep, that's a good point. Now, we checked. I got Ali to check. This is digressing a little bit here.
Yeah. With
Colonial First Tech.
Yeah.
And I said, can we use bring forward?
Yeah.
So 100 this year of non-concessional, and it goes up to 110 next year.
I looked into this as well, Michael.
So 2 times 110. Can we make a $320,000 contribution non-concessionally this financial year? He says no.
No.
Yeah.
Yeah. So I've got to do. I got to do, like we were just discussing this before we started this podcast. This podcast will really just be about these are the changes, here are the facts.
Yep.
What we're going to do off the back of this is, and what we're doing at the moment is, we'll be going back through all of our existing clients and through some different case studies and things like that, and working out how do these limits and how do these things impact people individually? Because this is invariably what happens is the government comes and changes the rules. And then it sort of seems very simple, but then there's all these edge cases of, okay, well, if you're making, like that example, so know that you can't use that up. However, there are different situations where the caps will apply differently. So it's definitely something that there's more research that you and I will be doing over the next few months and looking at with all of our clients as to how can we take advantage of this? How do these changes impact people who are potentially already making some of these contributions, who might have already made bring forwards, all those sorts of things?
Well, it's a good one, Dallas, because it sort of highlights what we do for our clients. One of the big things that we do is we keep abreast of legislation.
Yeah.
So our clients don't have to be burdened by keeping up with legislation changes and then applying it and saying, okay, does this apply to my situation? So, so a big part of our job is to keep abreast of those legislation changes and then run the ruler over all of our existing strategies for existing clients and say, okay, is this going to impact them at all? Is there any advantage that we can take by tweaking things a little bit? So it's one of those things that people do see as a genuine value add that we offer to them.
It's one of those things, like I feel like the legislation thing is a great example of just division of labour. So if we've got 150 clients and this new legislation comes out, you've either got 150 people, 150 couples that have to go, oh no, I've read this thing in the newspaper, the contribution caps are going up. What does that mean for me, and what does it mean in general? And then what does that mean as it relates to me, and how does that impact me trying to achieve my goals? Whereas we look at it and we can do all the research, spend all the time, spend all the energy focusing on it, because we know that we've got 150 case studies that we look at and go, okay, well, how does this impact this couple or these people, or it might impact this one but not this one, all these sorts of things. So you did right. It's one of the big value adds, I often find this with new clients where I think I do a better job of communicating that now, but sometimes I used to have a new client when they first became a client, they'd read something in a newspaper about legislation changes and they'd send it to me and go, hey, you across this? And after doing that 2 or 3 times, they'd go, oh, okay, I get it now. You're across all this. This is your job. We're already thinking about it as to how it relates to our clients. But there's another change as well with the
transfer balance cap.
Yeah.
So what the transfer balance cap is, you would have heard us refer to the $1.6 million per person.
Yep.
That you can essentially move into a 0% taxed superannuation fund at an appropriate age. We won't go into the details there. But basically, we've spoken about between a couple, if you do it correctly, you can have up to $3.2 million of funds, 1.6 million times 2, because it's per person, effectively in what we would call a tax-free company. Think of it as a tax-free trust or a tax-free company. It's just your superannuation funds turned into a 0% taxed environment. So that's going up to $1.7 million, which is, of course, a good thing. What it means is that people out there listening in that firm middle, so not significant high net worth, like we're not talking north of 10 million.
Yeah.
We're talking in the $3.4 million range here of retirement savings. You can actually you're right in that spot where you'll never qualify for any government benefits. But you're in that spot where you can still remain in 0% taxed environment forever and a day once you've retired. So if set up correctly, you should never pay a dollar of tax ever again if you're a couple with $3.4 million of retirement savings now. And you're right in that middle where you can obviously be fully self-funded for the rest of your life. You'll have to be.
That's right.
Yeah. But not pay any tax either.
It's a good point. I think that's one of the big things when most people want, or a lot of people that you talk to, leading up to retirement, they'd really like to get some age pension because they go, I've been paying tax all my life, I want to get something back. What I often say to people is like, forget about it. You're not going to get any of that. Your equivalent of the age pension is going to be to be able to use this tax-free environment. So that's essentially the benefit that you will get a cash transfer. You won't get payments from the government. What you'll instead get is you just won't pay any tax. So all of the tax that you would have been paying, think of that as your equivalent as your age pension.
Yeah.
And like you said, pretty much for anyone who's plans to retire with more than $1 million, which anyone in their 50s now, it's sort of going to be them. If you're retiring with more than $1 million, it's very unlikely that you'll be able to get any age pension. If you plan to retire with any more than $1.5 million, you really have to work on being self-funded fully forever and a day. And so that's kind of the big one there that we, like you were talking about, is that for our average person who comes to see us who does need to be a self-funded retiree, one of the biggest government benefits you can pick up is that tax saving. And this little increase to this transfer balance cap is just a bit of an extra bonus as to just a bit more money that you can get into that tax-free environment. Because the point you just made there, Michael, is that two people can, each person can have $1.7 million in that tax-free environment. Now, in reality, what we tend to see is that of a couple, one of them tends to have a higher super balance than the other. And there's all sorts of things that we do look at as to how to make sure we keep that as square as possible so they can both take advantage of it. But if you've got one member of a couple who's been a higher income for a lot longer, it often becomes a situation where they might retire with more than the transfer balance cap. They don't get to transfer that across to the other person. That it's only per person. So I think this one will be a real advantage to a lot of our average clients that come and see us, where they might have the two members of a couple, but one of them has stayed home with kids, one of them has been in the workforce for longer, and the super balances are very different. So, but like you say, these are just the facts for now. We'll be going back through and looking at how does this actually apply to our clients now who are retired and who are coming up to retirement. And by doing that, we'll know how that impacts everyone, and we'll be sharing these case studies with you on this podcast. And as we said before, if the thought of this, as we said in a recent podcast, if the thought of these contribution caps or this legislation change, if this makes your brain hurt, if this makes you just want to curl up in a ball and not think about it, feel free to give us a call, because like I said, we get really excited about this. This is what we want to be looking at, is how does these changes impact people? How can we work with these rules to help people get where they need to be with their retirement savings?
Yeah. So the changes come in on the 1st of July 2021. Before you go, if you could just remember to please fill up those empty 5 stars on your podcast app player. 5 stars would be a fantastic review for us. It'll take 2 seconds. We certainly want to get the word out and get more people listening to the Money Over 50 podcast. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.